Business 101 students, hi, Catherine Robertson here. I realize it is Tuesday, 4:30, and I am giving you your intro video for the week, chapters 9 and 10. I'm also going to talk a little bit about the project as it's moving forward. We don't have a discussion this week, but you do have a homework, chapters 9 and 10. I'm giving you an extra day since this is posted. It got posted or revealed a little bit late, and so you have until Tuesday of next week to submit that homework, just an FYI. Okay, so if you are looking at this week's material, we are moving forward into chapters 9 and 10. Chapter 9, if you are looking at chapter 9, we start to talk about finance basics and talking about raising capital, right? And it depends on if the company is, if you're an entrepreneur and you own the company yourself, right? Or if you are working for a larger company and you work in the finance department. And so there are a few different ways that you can go about raising capital, and there are lots of different things, from loans from banks to finding an investor to direct contribution if you're the owner. If it's a publicly traded company, you can issue stock and go about raising capital in that fashion. And really, one of the main goals, though, whether you are the owner of a company or you are part of the financial management team, is to maximize the value of the company, the firm, for the owners, right? Or for yourself. Now, if you're part of a financial team and it's a publicly traded company, you are maximizing ownership, or you are maximizing the value of the firm for the shareholders, right? And that is really who you answer to in a publicly traded company. Companies like the companies you chose for the project. And I will have a separate video talking about the project and choosing your company and going through, and that is due the final week of classes. So that is due the end of May. And you also are going to try a 4 to 5 slide PowerPoint that you do not have to do a voiceover for, but I'm going to have you post that. I think I have you post it in a discussion board so that you can look at other people's, right? So you just post your company there. So you'll have the paper that you turn into me, and you'll have a PowerPoint that you will post to a discussion board. Okay, so when we are thinking about risk, we are thinking about capital. We're thinking about risk return trade-off, right? The riskier the investment, the bigger the return typically is. It's the only reason we get involved in a risky investment, right? And that's whether we're expanding our company or we're getting involved in something in the stock market, which is chapter 10. So chapter 9, this week's 9 and 10, both are relating to finance, but chapter 9 is more directly related to when you read in the textbook in chapter 9 and you look at the PowerPoint and you work on the homework, you will see it's related more to internal within the firm, right? How you raise money for your company, whether you're an entrepreneur or you are on the finance team of a small company, or you're on the finance team of a large publicly traded company. Another thing to think about, I'm not too concerned that you are fluent in ratios, but to think about things like when we're thinking about a ratio analysis, it's really comparing two components, right? So for instance, in the slides in slide 8 in chapter 9, this idea of asset management, the asset management ratio, leverage ratio, or profitability ratio. And really what these are like, they're telling us, they're giving us a snapshot, right? They're giving a snapshot like taking your temperature, right? It doesn't tell you everything that's happening, but it tells you if you have a temperature of 104, you know that something's wrong, right? But if your temperature is normal, right, 98.6, I believe, right, then at least you're saying, well, your temperature is normal, right? You're probably not fighting anything off because your temperature would be spiked. So these, you have to kind of take them as what they are, like the asset management ratio. It measures the effectivity of a firm in using its assets to generate revenue. That being said, so assets meaning all of the things that the business owns, right? Cars, furniture, accounts receivable, building, inventory, if they do service like client list, all that's considered an asset. So if they have $100,000 in assets, right? And then we look at whatever their revenue is. And so we say, okay, you have assets, you have a pile of assets, and you have a pile of revenue. How do those two numbers compare, right? And so if you look at a bunch of firms within an industry and you look at how their assets, like really what the company owns, how big they are, and how much revenue they generate, that tells you, and that comparison tells you. So if you have a company that has a whole bunch of assets, it's a big wealthy company, right? But they're not really, they have a small amount of revenue. You're thinking, well, they should be able to be, they're not applying themselves. They should be doing better than what they're doing with the amount of assets they have. Conversely, if you have a company that maybe doesn't have that many assets, right, it's a small company, but it's generating a ton of revenue, that's something to look at, right? What are they doing differently? To you, they're using a small amount of input to get a large output, right? And so that's when we have that ratio. It can tell us measurements there. So when you're comparing companies side by side, leverage ratios, another comparison, right? And this measures the amount of debt a company has, right? So if the company is $1 million company, is the company, are they $800,000 in debt? They're valued at $1 million, but 800,000 of that belongs to somebody else, a bank or accounts payable or whatever it might be, versus a company that maybe is $1 million company that only owes 100,000. So they have a bunch of equity in the company. So how well they're leveraged? If they have high leverage, meaning they have a lot of debt, versus if they have a low leverage ratio, not much debt. And so thinking about those two in particular gives us an idea about what the company, uh, how the company is doing. And we can use that then to compare against other companies, right? Investors use that often. And so review the items of a budget, right? And how you might do some budgeting. Ideas of short term financing, trade credit, right? You might trade with another business for a dollar amount, their services for your services. A line of credit is just another tool that you could get from a bank. Same with commercial paper, that is another tool, a short term tool that corporations, large corporations use. All right, the types of financing you could get long term, many you've already heard of. You can invest the earnings. So if you own a company, you can invest a lot of the earnings and profits back into the company, or you can often take out types of loans, right? Either from a bank or from some sort of loan institution. Capital structure, and this is just how your financing is laid out, the mix of what you have equity wise, right? And we had mentioned earlier about the leverage point, how much equity you have versus how much debt you have. And, when we're thinking about leveraging, we do want to have some debt. You want to use other people's money to grow. That is one of the key things, is to use other people's money to grow. And if you're making money or have money invested in the stock market, leave it there if you're getting a good return. And at a lower rate, right, you might borrow money. So you're still making the spread between the lower amount. Maybe you borrow money for 2% and you have money in the stock market at 8%. Leave the money in the stock market at 8%, borrow the money at 2%. You're still making 6%, the difference, right? After you pay the 2% interest. And so using other people's money or banks, aka banks' money, is an important component. When we think about items, we think about liquidity. We didn't talk about it much in the accounting chapter, but really items are listed when we're thinking about assets in order of liquidity, meaning that they are easily, a liquid asset means that it's something that can be easily converted into cash, right? And so when we're talking about companies that have a lot of liquid assets, it means they could be sold off basically, or turn things into cash if they needed to, versus things like land or buildings. Those are like not very liquid, right? It takes a specific buyer, it takes financing, lots of other things before those could sell. So they are not as liquid. And just thinking about how you might manage some of your how you might manage some of your assets, and thinking about accounts receivable, because that's considered an asset and that's tied back in with accounting as well. But if you have a bunch of people that owe you money, that you already did the service or already gave them a good, right, of some sort, a product, that is considered a fairly liquid asset. Like you have the ability to kind of cash call that in, right? And so that's account receivable is considered something along those lines. So chapter 9 really talks about financing within a firm. And when we're looking at then there's also a short video here about finance basics, right? So for chapter 9, you're going to watch the short video, finance basics, and when you're looking at Blackboard, and then you are going to review the PowerPoint and first read chapter 9, review the PowerPoint, watch the video on financial basics. The next chapter, chapter 10 for this week, there are two short videos. The first one on how the stock market works. Second one, Warren Buffett's famous guru, right? Investor, billionaire, owner of Berkshire Hathaway, or CEO now, a publicly traded company, talks about investing and some basic rules. And he has written many books. If you Google Warren Buffett, older gentleman out of Omaha, he is one of our folks that I don't know if we have any. We may have a couple books by him in our library. But so chapter 10 talks a lot about the stock market. And when you're looking at chapter 10, and as you see at the bottom there, chapters 9 and 10, homework is available for you. So I think there's a total of 9 questions between the two chapters. The chapter 10, when you are looking at chapter 10 and you're talking more about the stock market and financial markets, right? You're starting to think about how those markets play out, talk about credit unions and savings and loan institutions and how we do our banking, really. A few things to note. Institutional investors are large investors, right? I'm not as concerned that you know about securities brokers and dealers, but just know that there are large investors, such as big organizations, colleges, right, might invest all of their 401ks. The one thing, or their 403B, for nonprofits, 401k for profit. There are a couple things that I do want you to know from this chapter, and there are some. The Federal Reserve came into play in 1913, and that is what got the Federal Reserve System up and running right before World War I. After the actual crash of the market and the Great Depression, 1929, the Banking Act of 1933, and the Securities Act of 1933 is really what got the Securities and Exchange Commission up and running. There's a bunch of different acts in this. The one that I really want you to note is the Sarbanes-Oxley Act of 2002. It was mentioned back in chapter 4 in the video, talking about it was our legislator, our federal government coming up and saying that there needed to be more tighter parameters on publicly traded businesses and looking at financial statements. There are a whole host of items tied to this Sarbanes-Oxley Act of 2002. You will hear it in a lot of business courses. We had a lot of issues in the late 90s and early 2000s relating to companies being unethical and hiding things in their accounting statements, which then basically they're defrauding investors at that point because the investors thought the companies were doing better or were more stable than they likely were. So 2002, common stock versus preferred stock. Basic ownership is common stock. A bond, something typically we see issued by a government entity, right? And government bonds are virtually risk-free. They do have a very low interest return, but in exchange for that, you have almost a risk-free investment because you are investing in the government. Something to note as well on slide 9, a mutual fund. Most of you should know when you leave this course what a mutual fund is. And this is really when we're thinking, and there's pictures of it in chapter 10, when we're thinking about having someone else manage our money, right? We talk about, or you've heard about being diversified and having different types of stocks, right? Well, you can buy into a mutual fund, right? Maybe you want to buy 10 shares of a mutual fund X, right? And that mutual fund actually is divided into different sectors. Somebody else is managing that mutual fund, which is already diversified, right? So, and so you may want to do that. That is a portfolio of different stocks. Sometimes it has bonds in it. And that's part of a mutual fund that you can invest in. Some of you might be invested in mutual funds. Capital gains on slide 10 talks about if you have something, you bought something, right, and you sell it, what is the gain on it? So you bought a house for $100,000, you turn around an investment property and you turn around and sell it for $150,000 2 years later. That $50,000 technically is a capital gain, and it's taxed differently, but it's still taxed by the government. Review features of bonds and the primary security market. This is what we think of IPOs, right? And I know that is a question on your homework, and that is the initial public offering, an IPO. That is when a company goes from being a privately held company to a publicly traded company and something on Wall Street. We had Facebook go in my lifetime. I think that was 2012, 2013. Facebook went public. And so they went from a privately held company into a publicly held company. And when they do that, then the SEC, Securities and Exchange Commission, has a whole host of things that they uh, want the company then to kind of list for investors. They are making the company do things publicly so that investors, the public, know what's happening within the company. And so this actually ties into your companies as well. And when you publicly traded companies, all must have something called an annual report or 10K. And so when you are thinking about your company, you're going to go to the company's website and go to the investor portion, and you are going to find the 10K in that investor. I will do a short video on how to find your 10K on your website when I talk about your company and your project. Other things to note from this chapter: a stock exchange, like the New York Stock Exchange, is where you trade stocks and securities. The over the counter, the OTC, a little bit different, but they are that we have an OTC listed out of Chicago, and that is NASDAQ, right? Market orders and limit orders, those are mentioned in one or both of the videos tied to this chapter, and talking a little bit about how you might go about buying stocks, right? You can set a limit order. You can do it yourself, actually, if you are on E-Trade or Charles Schwab or one of those. You can set that if a stock goes to if it drops to a certain level, you have it set to automatically buy. You have it tied to a bank account or some store of money. Or you can have it set to sell. So maybe you own a stock and it's at $20 a share, and if you have in there, if it ever goes to $50, sell it off, right? So you can let your money. This is what sometimes folks will do. It will work while you're not even. You might be out doing other things, and it's buying and selling shares for you if you set limit orders. There are several strategies for investing. Some people invest for income, and they buy things, buy bonds or stocks to generate a steady income. Some folks get into something called market timing, and this is investing by analyzing when the prices of specific stocks are likely to rise and fall. So, folks that study the market and they analyze things and say, okay, we see some predictors happening. This stock is going to go up. I want to buy it now. Or this stock is going to come down. I see some predictors that I've seen before or indicators, and so I'm going to sell it before it gets too low. Another option is investing for growth. And you might invest in companies then that you've researched that seem like they are going to grow, or they are in sectors that there is potential for growth, right? A lot of the green initiatives and climate friendly fuel sources are in emergent areas for growth. Let's see what else. Also, value investing, trying to find things that are undervalued in the market, right? That's how buy low, sell high. You've heard that expression, right? And the last one is buying and holding stocks. So this is one where you might buy a stock and you're just going to hold it for as long as you can, right? You just hold it for a long period of time. And typically what we see is the market over time always has gains, right? And so that is a long-term strategy for investing. Two different statistics that you might have heard of or might know: the Dow Jones Industrial Average, which tracks stock prices of the 30 large well-known U.S. corporations. And this sometimes you will see one or two change depending on the size of the business. Maybe a company gets a little bit smaller, or a company gets a little larger and nudges one out. The other one is Standard & Poor's 500. This is based on prices of 500 major U.S. corporations and a variety of industries and market sectors. Couple things to note on slide 20, and also in your chapter exhibit 10.2, the major stock price indices. We see the NASDAQ composite, all the domestic and foreign common stock traded on the NASDAQ exchange. So that's the NASDAQ composite. That's what it tracks, right? The Wilshire 5000, this tracks stock prices of all U.S. corporations with actively traded stock, right? So there are over 6,000 stocks in the Wilshire 5000. The Russell 2000 is stock prices of 2,000, relatively small, but actively traded U.S. corporations. The FTSE 100, stock prices of 100 of the largest, it's FTSE, but FTSE, you may have heard that. Stock prices of 100 of the largest and most actively traded companies listed on the London Stock Exchange. The Nikkei 225 is a stock, or NIKKEI, prices of 225 of the largest and most actively traded companies listed on the Tokyo Stock Exchange. And last but not least, the SSE stock prices of all the stocks listed on the Shanghai Stock Exchange. And so just take a minute or two there, or actually several minutes to review. First, to read both of those chapters, 9 and 10, review the PowerPoints, and review. There are 3 total videos this week outside of the instructional video, and then complete chapters 9 and 10 in the homework. Be looking for, you've already chosen a company, make sure you explore the website and start to look for the investors portion. It's a whole other side of, it's for non-retail items, right? And see if you can locate the annual report. So that's going to be your job, is locating your annual report. And we will talk in a later video this week about your project, which is due for this course. And it is not due until the last week of classes around May 31st, June 1, that weekend. The project is due and the PowerPoint is due. By Monday, actually, the 3rd, you will have to turn in all of those items. That's the last day. The last day of classes is the 31st of May. But you will have until through that weekend to turn in all of your last items relating to your project and your PowerPoint. Have a great week, and I will circle back around you soon.